Hi, this is Rayne, and welcome to another episode of Wind Down Wednesday. And Joe, it's great to have you back again. It just seems like it was yesterday when you were on the show. I wanted to kind of start by telling everyone in terms of how kind of our conversation started about assumable mortgages. I was working with a buyer, and he's really been having a hard time trying to find the right place. He lives in a condo, so he's got to sell that place, and he wants to move into a bigger place since he's been working a lot from home. And recently his parents actually moved into the area, so we're looking at some possible places where he could possibly either move up and maybe move in with his parents as well. And I was looking at properties, townhouses specifically in the Arlington area, and I stumbled upon a listing that had something called an assumable loan. And I talked to you, and we kind of talked about that in terms of how easy or hard it is to assume that loan. So maybe we can, you can kind of share with the audience a little bit more about how that went, because I was a little surprised by what I learned.
Yeah, absolutely. So I think a lot of people are unfamiliar with what an assumable loan is, and on the surface it sounds like the best deal you can get out there, especially in a market where people who bought in the last couple of years have an ultra low interest rate. We're talking 2 or 3%, and today they might be getting something more like 6 or 7%. So
Yep.
taking over somebody else's loan or assuming it means that you're going to take over the loan amount, the interest rate, and the monthly payment on that loan exactly as it stands today. And so you're taking over that maybe 2.5% interest rate. And the biggest catch here is the loan amount that you're taking over. It's definitely going to be less than whatever that prior person purchased the property for. And unless the home is upside down or worth less than what it was before in that last purchase, there's going to be a gap between the loan amount that is still on the home and what the new purchase price will be. And we're going to come back to how we calculate out whether or not this is a good idea later, but let's just keep that in the back of our heads for now.
Yeah, and I think in our example, whenever I talked to a listing agent, it was a VA assumable loan at 3.5%. That person had bought it in 2012, so had been paying pretty regularly, but they also financed the full amount. They didn't put anything down with their VA loan, and they actually financed the VA funding fee as well.
Yeah.
So that's kind of what I discovered in the process, and actually talked to Wells Fargo, the bank, as well, in terms of how easy or hard it is to assume that loan.
Yeah.
But I think we'll go into it a little bit more later.
Absolutely. And so that's really the second step is you don't go through a traditional mortgage lender to figure out how you assume a loan. You have to go directly to whoever currently services the loan. In this case, it's Wells Fargo. And what you're going to find most often is it's a major player out there in the market. There's definite economies of scale for holding loans and servicing them in a large portfolio.
Yeah, and I was going to say, Joe, it actually was not easy because I had to talk to the listing agent. The listing agent had to talk to the owner. The owner had to call Wells Fargo to authorize me to talk to Wells Fargo. So I feel like I have like a little key in my pocket to open the door to this assumable loan at Wells Fargo now.
Absolutely. And so one last thing we should touch on now is that all VA and FHA loans that are originated today are assumable by default. And so that's mainly what you're going to see out there in the market for on the MLS agents listing. This is an assumable loan and the seller is willing for somebody to assume it. There are some other bank products out there, some more specialized investors that will allow it, but much less common.
Okay, great.
So we went ahead a little bit on this, but you touched a little bit on the struggle that there can be between when you decide I want to assume this and when it can actually happen. So can you share what Wells Fargo told you for the timeline for that closing?
Yeah, exactly. As I mentioned earlier, they said that it's going to be around 60 days for the VA assumption to happen. And I think what was difficult was talking to the buyer and trying to figure out how they can come up with the balance between what we would, and we haven't made an offer yet. So this is the difficult part in terms of talking through it, in terms of the difference between what we would buy the property at minus what the existing loan amount is for the VA loan that we're assuming.
Right.
And he would have to come up with that difference in price. And it was significant. It was over $300,000 depending on what the final sales price was going to be.
Sure. Yeah. And so that timeline is going to vary by loan type, From what I've heard, FHA is maybe a little bit faster, more like 45 days, but definitely significantly longer than what we're seeing in our market, where closes between 21 and 30 days are the norm. Any seller who's trying to have someone assume their loan might be in a little bit more of a desperate situation where they're trying to add value to a buyer coming in by giving them this loan and may be willing to wait that extra month to get their proceeds.
Yeah, and I would say in this case, having less time is definitely not beneficial, at least from the buyer's perspective, because as you can imagine, even though he would want to buy another place, he was just really surprised at how much money he would have to come up with to try to close that gap and
Absolutely.
try to buy a place.
Yeah, and so that gap can either be closed by bringing cash to the table, so you have no other liabilities on the property, or what's more common is to take out a second lien or a home equity line of credit to help you with that additional purchase price to bring you to a total loan to value closer to what you would have offered originally, whether that was minimum down payment for FHA at 3.5% or 5% for conventional loans.
Yeah, I hope we can get it done, but I think it's going to be a real struggle, Joe, because I mean, you're talking about getting a home equity line of credit, and we haven't even made the offer for the purchase of the place yet, and haven't even gone through the inspection or any of the contingencies. We're still in the early phase, so we'll have to see how that works out.
Absolutely. So I think it would be really good right now to touch on some of the pros and cons of assuming a loan. So biggest pro out there, you get a much lower interest rate on this new loan. The flip side of that is what you really should be concerned about is the blended average interest rate. So if you have one loan at 3.5%, but your equity line of credit is at 8.5%, is that really a better decision for you to make? The next thing is VA loans can be assumed by anyone, not just a veteran. So really opens up the pool of possible assumptions there. And then sellers marketing this are really giving themselves a leg up over the property next door that does not have an assumable loan.
Right. I mean, it seems like on the surface, it's really good to possibly assume this loan at a much lower mortgage rates. But you really need to have some financing lined up, or have parents or grandparents or someone that might be able to give you a gift to kind of make up that difference.
Absolutely. Cash is king, especially in this example. If you really can lock in that 3.5% rate, you're going to be really sitting well.
Right.
So a couple of the cons here, mainly for veterans here. When you allow someone to assume your VA loan, it does not restore your entitlement. And this is really important for somebody who wants to use their VA loan to buy their next property when they sell their current one. The VA has a fairly complex formula for how we figure out what their remaining entitlement is. One of those factors is currently used entitlement. And so without releasing that, it will reduce their options as far as what their down payment needs to be on the next property. And it probably rules out that 0% down loan that they may have used on the initial loan.
Yeah, that's good to know. It seems like from the listing agent, this seller was definitely motivated because he was willing to give up some of his entitlements in order for someone to assume his VA loan.
Absolutely. So the next thing, liability waiver. This is the biggest downfall for sellers. And it's not something that is guaranteed. It definitely needs to be negotiated in there with whatever the servicing lender is at the time. And the liability waiver is a document that states that the liability actually transfers to the new buyer and that the seller does not retain any liability. Where that's really important is if that new buyer defaults, it not only affects that buyer's credit, but it can affect the seller's credit too if they do not have a liability waiver.
That sounds pretty major, Joe. I would definitely get a liability waiver if I could.
Absolutely. And so with FHA loans, that's only possible if the loan to value on that assumption is 75% or less. So that's a key metric to make sure that you are below.
Right. So you're saying in terms of that 75% or less, I know it's a different loan type in terms of FHA, is that let's say the balance is 50%, then the buyer will have to bring more cash to the table or financing to the table to get up to the 75%.
So you actually want to be below 75%.
Oh, below 75%.
That's right.
Okay.
Yeah, absolutely. And so, we already covered that the major con here is finding that second rate where the blended average is lower than maybe going with a brand new mortgage. And then last couple things here, the VA funding fee is due when you assume a loan. So 0.5% of the current loan amount you have to pay as cash at closing. And then lastly, there's more cash to be paid because you're paying two sets of closing costs, one for the assumed loan and one for the equity line of credit you're using as the second lien.
Yeah, and that sounds like closing costs could be a lot if you're paying it on two loans. I know when I talked to Wells Fargo, they gave me an estimate for that loan of $350,000, and they were saying it's going to be a little over $9,000 for the closing costs just for the assumable loan part.
That's right. So, a lot of things to consider there, but I think we've got an example up next for the particular property you were actually looking at.
That's right.
And so this property in Arlington, sales price $625,000, and let's just assume that this buyer was going to go in with a 10% down payment.
Okay.
Current rate on that assumable loan is 3.5% and a balance of $350,000. So what we covered earlier is that you assume that interest rate, you assume the principal and interest terms of that loan, and you assume the balance. So $625,000 less $350,000 leaves a pretty significant chunk to get to a total loan to value of 90%. And so on the left side here, we presented the numbers of what that looks like. So the current payment that the seller is making is $2,041 a month on just the principal and interest. And if you financed that second tranche of the loan for a little over $250,000, the principal and interest on that portion would be $1,633 for a total payment of almost $3,700. So that's the best case scenario on assuming that loan. Now, if we look at a brand new loan, 10% down, this is a product that is exclusive to Embrace Home Loans for anybody who has 680 credit or above and 10% down. Really good way to get into a property for less than 6 or 7%, which is what a lot of other people are quoting now. This loan, at an interest rate of 5.75, would have a principal and interest payment of a little over $3,400. And so just in this case, the monthly savings is $210 just by going with a brand new loan, much less the avoiding the 0.5% VA funding fee or double closing costs that you might have to pay.
Yeah, what's the name of this loan that's at Embrace Home Loans, Joe?
This is called Prime Plus. 30-year fixed rates, still in the fives. I have not been able to find a better product out there, and it's been a great way for us to add value to our clients.
Yeah, it sounds pretty amazing at 5.75% when we were just talking about it before. That current conventional mortgage rates were like a little above 7% right now.
Yeah, that's right. And the best part about this product is there is no interest rate adjustment for condos, and every single credit score, 680 and above, is treated the exact same. So usually there's different levels of interest rate adjustments based on credit score. Everybody's treated the exact same at 680 or above.
Yeah, well, I think this is another great advantage in terms of kind of the edge that you're going to have as we're working together with other buyers to try to get them the best mortgage rate possible in today's rising interest rate environments.
Absolutely. So, Rayne, my intention today was not to scare people away from using an assumable loan, but really to give them a little bit more education on the steps that you need to take. There's definitely a lot more research you need to do, both with figuring out the exact terms of the loans you would assume, getting a quote for what that second lien would look like, and then taking all those numbers, talking to a qualified professional, and figuring out whether or not it's actually in their best interest to assume that loan.
Yeah, no, Joe, this is really educational because, on the surface, with my simple brain, when I looked at it, I was like, wow, this sounds too good to be true. It's 3.5%. I know that's a lot lower than it was 6.5% at the time in terms of what a mortgage would be. And I was just simply thinking, well, they could just assume that. But then I ran into difficulties in terms of getting the buyers to come up with the extra cash to kind of fill in that difference in the sales price in the assumable loan portion. It was great to talk to you because I never thought about, just getting a brand new loan and how that might actually be just as good. Definitely a lot easier than trying to assume a loan.
It definitely is.
Yeah.
I don't envy the buyers out there today. They're definitely having to get creative. So we've talked about how to purchase discount points to maybe make your offer a little bit more competitive, especially if you can get that paid for by a seller. We've covered assumable loans. Yep. And I think that we're going to be coming back for your listeners with some more good tips on other creative strategies for how they might be able to give themselves a little extra juice in this housing market.
Yeah, definitely look forward to hearing more about those creative strategies because I feel like in today's market, negotiation, again, is key. And, for me as a realtor, I think finding out information and helping my buyers or sellers kind of walk through each step of the process is really important. So I definitely appreciate your insights today. And I guess as we're getting into the fall, I was going to also share with our listeners, I think something else that I've really am looking forward to in the fall is, I don't know if you have glühwein. It's basically heated up red wine with some spices.
Okay.
I think as the weather's getting cooler, that's something that I would recommend. It doesn't have to be a really expensive bottle of wine.
Let the spices do the talking.
Yeah, that's right. Yeah, exactly. So that's my recommendation for this week. And thanks again for tuning in to another episode of Wind Down Wednesday, and have a great day.